Yeah. So we will continue our session. This I will go for next one. Yes. Yes. Working capital assessment. Working capital assessment, three methods are there. First one is called as turnover method, which is otherwise called as PR Nayak committee recommendations. And the second one is maximum permissible bank finance method, MPBF method we call. It is under second method of core committee, Chore committee or core committee, whatever it is. And third one is your cash budget method. So these three methods very important, and we will see continuously one by one. First one is turnover method. Turnover method main concept is 20% of the projected gross annual sales turnover accepted by the bank. This is principle. Just how it will be, I will show you through this PowerPoint for understanding this turnover method. Right? This is what. Okay, command is not nothing. So projected turnover accepted by the bank. Party will submit balance sheet where projected turnover he will mention, and it should be acceptable whether it is realistic or not. That we have to accept. If you accept, on that you calculate. That is why projected turnover accepted by the bank. For example, 10 crores is projected turnover, and out of that 25% of projected turnover is working capital requirement. वर्किंग कैपिटल रिक्वायरमेंट, दैट मीन्स ये कंपनी को वर्किंग कैपिटल के लिए कितना पैसा चाहिए, दैट इज 25% ऑफ प्रोजेक्टेड टर्नओवर. हियर एग्जांपल इज 2.5 crores. So out of this requirement we will finance some portion. Party has to bring some portion. Party का portion को हम बोलेंगे margin, and our portion it call as permissible bank finance. So projected turnover, 25% of the projected turnover is working capital requirement. Out of working capital requirement, we finance some portion, which is called as permissible bank loan, and party will bring some portion, it is called as margin. So our portion, what is party's margin? 5% of projected turnover is prescribed margin. Here example में 0.5 crores, 5% of projected turnover. Tell me 5%, it is 0.5 crores. And available net working capital in the system, it is 40. It is not in this equation, but it will come through balance sheet analysis में आएगा. What is NWC, net working capital? It is total current assets minus current liabilities. It is called as net working capital. Current assets minus current liabilities is called as working capital, net working capital, or otherwise also long-term sources minus long-term uses. Long-term sources minus long-term uses. Okay, that it will come in balance sheet. For understanding purpose, only current assets minus current liabilities, it is called as net working capital. So it will come in balance sheet. It is only for information. Why it is informed here? Suppose available net working capital is more than prescribed margin of 5%, then this will be deducted from this. I will tell you for understanding purpose. Now इसको अलग रखेंगे. Only this point tak we will come. So projected turnover is 10 crores. 25% of projected turnover is working capital requirement, and 5% is margin. So your 0.5 is margin. So what is your permissible bank finance? 2.5% is requirement. Party is bringing 0.5, then 2. So this is called as 20% of projected turnover is required bank finance. 20% of projected turnover is required bank finance. 5% of projected turnover or available net working capital in the system, whichever higher is margin. So margin should be 5% of turnover or available NWC, whichever is higher. So here available NWC is 0.4 and 5% of turnover is 0.5 crore. So highest is 0.5. So this we will deduct from requirement, and permissible bank finance will come 2.5 minus 0.5. So this is how turnover method. Sometimes he may ask by giving simply 10 crores is projected turnover. What is working capital requirement? He will ask for confusion purpose. Requirement पूछा तो 25%. What is working capital finance under turnover method बोला तो 2 crores. 20% is working capital finance. 25% is working capital requirement. Out of requirement, 5% of turnover is margin. So margin come करने के बाद permissible bank finance will come. This is called as turnover method. But this method is applicable to whom? If the minimum margin is 5% are available, net working capital in whichever is higher is margin. Current ratio 1.25. This is applicable for MSME, manufacturing and services up to 5 crore working capital limit. This is applicable. Other than MSME, up to 2 crores. And traders, merchants, exports and IT software, etc. up to 2 crores. So traders and merchants, suppose if anybody comes under MSME, it goes to MSME. If they are not classified under MSME, then only up to 2 crores now will come. So this is about turnover. But sometimes for confusion purpose in exam, they are asking, borrower can opt for MPBF or cash budget system and bank can employ if the same is more suitable and appropriate for assessing their working capital. How they will give for confusion purpose? SME unit requires finance of 5 crores. Which method you will adapt for working capital assessment? This is the question. So first one itself, they will give turnover method immediately because SME 5 crores, it is turnover. We may go for turnover immediately. But second question, he will give MPBF. Third one, he will give cash budget. Fourth option, they will give either MPBF or cash budget or turnover as per option of the borrower. That is fourth option. So you have to go for fourth one because wherever borrower asks for MPBF method, always it is prevailing over other two methods. If borrower asks MPBF, we have to proceed because their current assets we take mainly for MPBF. That means current assets creation is there. So we give priority. Right? This is about turnover method, first one. Then we go for second method, MPBF method, maximum permissible bank finance system. This is applicable beyond cutoff turnover. That means more than 5 crores is case of SME, more than 2 crores in case of non-SME. This method is applicable and current ratio is 1.33, requirement of current ratio. So limits over 25 crores can be assessed on the basis of MPBF system or cash budget system. As it is, I told you, whenever party asks for MPBF system, always it is prevailing. Now, how to calculate this MPBF? I will tell you, show you MPBF system B. Next one, yes. MPBF system. Total current assets, we call it as gross working capital. Total current assets, it is 40 crores. Less current liabilities excluding bank borrowings. It is 8 crores. It's an example it is given. Then comes working capital gap, 32 crores. Problem. And now question, earlier recalled question is there. What is working capital gap? What is working capital gap? Working capital gap is nothing but total current assets or gross working capital minus current liabilities excluding bank borrowings. So without including bank borrowings, you have to take all other current liabilities. Here it comes. Example mein 40 crores is gross working capital or total current assets and current liabilities other than bank borrowings is 8 crores. Then working capital gap is 32 crores. That means up to 32 crores that party requires working capital. In other words, we can say his total current assets is 40 crores. Out of that already financed 8 crores to somebody. Now gap is 32 crores. It is called as working capital gap. In this gap, we will finance some portion. Party will bring some portion. Party how much kitna lana? Party's prescribed margin is 25% of total current assets. It is prescribed margin under this method. So total current assets are working, gross working capital kitna here? 40 crores is total working capital or total current assets or gross working capital. Out of this, 25% is margin. That means party may 25% is 10 crores. So 10 crores is margin. 32 crores is gap. 32 crores may 10 crores party has to bring because his margin. Then 22 crores is maximum permissible bank finance. Right? Working capital bank gap may party has to bring 10 crores. That is 25% of current assets. Then 22 crores is MPBF. Suppose Available net working capital इसमें 9 crore दिया. Suppose it is not 9 crores, party is already having 11 crore उसके पास है. For example, he is having 11 crores. So दोनों में highest one 10 crores is 25% of current assets, that is prescribed margin as per method, but इसका पास ज्यादा है. For example, I will tell you, party wants to buy a car. We say 10% is margin, on-road margin. Party says, sir, मेरे पास 30% है. That means 10 lakhs is car cost. He is required to bring 1 lakh only, 10%. He says, मेरे पास 3 lakh है. So we give only 7 lakh for car. Similarly, here also 10 lakhs is 10 crores is his requirement. Party says, I am already having 11 crores. You verify my balance sheet. इसमें 11 crores is available. Working capital, net working capital. That is current assets minus current liabilities. 11 crores is there. So 32 minus 11. Here comes your 21 crores. This is how maximum permissible bank finance we arrive, right? Margin is 25% of total current assets are available net working capital in the system. Whichever is higher, that is margin. Here 25% of gross current assets is 10 crore. Net working capital, earlier I mentioned 9 crore. Hence we will take, suppose net working capital is 11 crore. This will be deducted from gap. Then 21 crores only maximum permissible bank finance will be there. This is called maximum permissible bank finance system, MPBF system, right? Next, we go for cash budget system. Cash budget system में simply whatever cash deficit is there, we call it as deficit financing also. Deficit financing. What is the deficit? I will tell you. April to March, he will give cash projections. That means what are all cash inflows in April month, cash outflows in April month. For example, cash inflows in April month are 20 crores. Cash outflows in April month are 30 crores. So here inflows less, outflows more, gap is 10 crores. We will say gap is 10 crores. Next, May month aa gaya. May month inflows are 10 crores, outflows are 25 crores. So May month में 15 crores gap आ गया. Now cumulative gap कितना है? पिछले महीने का 10 करोड़, इस महीने का 15 करोड़. Total 25 crores is cumulative gap. So like that we calculate what is the peak level deficit or gap that we will finance. It is called as deficit financing or cash budget system financing. Okay. यहाँ तो equations कुछ भी नहीं है. What is the deficit that we will take? Okay. Now it is applicability. Mostly in cash budget system, they are asking about applicability. Whom it is applicable? Borrowers enjoying fund-based credit facilities of over 25 crores. This is one. Second one, specific industries like seasonal industries like tea, sugar, software, and construction. Software, construction, tea, sugar. These are all specific industries we call. So there also this cash budget system is applicable, and NBFCs also compulsorily under cash budget system only we have to assess working capital limits. Wherever for valid reasons the borrower opts to avail working capital under MPBF system, the same may be. So party will come and ask, मुझे 50 crore चाहिए working capital. How you do under MPBF? You have to do, because I told you MPBF will prevail priority over other two systems. Okay. Now, bank shall finance a discounted net. This is another one. Discounted net cash flow in the form of term loan, repayable in more not exceeding 3 years. Whom it will be financed discounted cash flows for, as in the form of term loan, to good corporates or any corporate which is receiving definite cash flows from government entities, or AAA rated corporates, or credit card receivables where our bank POS machines are involved. Here we know sure that the party will get some amount. So against receivables, such receivables or cash flows, we will finance in the form of term loans. It is not exceeding 3 years repayment. It is called a discounted cash flows in the form of term loans. This is latest addition, about 3 years back it is added. Earlier it was not there, right? Next, construction companies के लिए assessment, we generally it should not exceed 9 times of net owned funds. Net owned funds means उसका own funds all. Tier 1 capital, Tier 2 capital, reserves, etc. Next, assessment for NBFCs, I told you already, cash budget method. Need not be linked to net owned funds. Gold card scheme for exporters. Normally, while sanctioning working capital limits to exporters, we sanction standby credit limit also. This is standby credit limit of working capital. Term loan separate, I will discuss in MSME schemes. This is standby credit limit of working capital for gold card exporters. Normally, at the time of assessment of working capital, 20% over and above the assessed limit, we sanction and keep side. Whenever party requires, he can avail this 20%, but maximum 2 times in a year, they can avail this standby credit, and each time not exceeding 60 to 90 days at a time. This is what standby credit limit working capital for gold card exporters. Next, lending on the guarantees issued by other banks. Sometimes what happens, other banks will issue guarantees to such person we can finance. When it arises, I will tell you. Suppose somebody is enjoying with one private sector bank, limits with private sector bank, like Karnataka Bank or whatever it is. So he may approach that bank for additional facilities. What that bank says, under that particular category, that is that industry type, their exposure is already reached, because Reserve Bank has prescribed these are all certain maximum limits for each industry. Don't go beyond these levels. So already their fund-based limits has exceeded that level or almost nearing. In such case, what they will do, they don't want to lose their customers. He is a good customer. So that bank says, Baba, I will give you a guarantee. You go and approach some other bank and get finance from that bank. So against such guarantees, we will finance. This is what lending against guarantees issued by other banks or financial institutions. So here the norm is the borrower should have satisfactory dealings with the bank for at least 3 years. He need not enjoy credit facilities with us, but at least his current account is there. He is running nicely with our bank for at least 3 years. That is one condition. And second condition, the guaranteeing bank should have fund-based exposure to the party to the extent of at least 10% of the guaranteed amount. That means the bank has issued guarantee for 100 crores. So we may finance against that guarantee for 100 crores, no issue. But the condition is 100 crores guarantee diya to that other bank may party ka fund-based facilities should be at least 10 crore, 10% of amount guaranteed. 100 crore guarantee diya, so at least 10 crores he should maintain, he should have fund-based limits with that bank. Then only we will consider. Simply he cannot transfer everything. Right. Next one, liquidity and current ratio norms. Current ratio norms already we have discussed. For turnover method or payer Naik committee recommendations ka 1.25. For MPBF or cash budget method, 1.33 is current ratio required. That is one. And these current ratio norms are not applicable for schools, colleges, hospitals, nursing homes, hotels, restaurants, service providers, infra projects, and plantation. These norms 1.33 or 1.25 are not applicable. Benchmark current ratio not applicable for sugar industry, also it is not applicable. Next, wherever party is enjoying working capital limits of 50 crore and above from the bank, or if current ratio is less than prescribed norms, that is 1.25 or 1.33, if it is less than that, then bank will obtain quarterly cash flow statements from the party to ascertain how the unit is running. So it is applicable quarterly cash flow statements where you have to obtain if party is enjoying 50 crores and above, number one, or current ratio is less than prescribed norm. In both cases, we have to obtain quarterly cash flow statements for monitoring purpose. And now it is latest additional one, ASM, Agency for Special Monitoring. 2 years back, it is introduced. Reserve Bank says, wherever exposure of the borrower is 250 crores and above, over 250 crores and above exposure, in such cases, for monitoring cash flows, banks are supposed to appoint agency, it is called as empaneled, approved empaneled firm. It is called as agency for special monitoring. So for this cutoff point is 250 crores se zyada, over 250 crores and above from banking system, not only individual bank. 2-3 banks se 250 crores pura diya hoga. Put together, all put together, if it is over 250 crores, compulsorily cash flows are to be monitored by empaneled agency. It is called as agency for special monitoring. For this again, we have to pay charges. Again, I will discuss in monitoring tools. Up to 500 crores aito 5 lakh per annum. Beyond 500 crores aito 8 lakh per annum. We will pay. Quarterly, they will monitor and submit reports for us. This is what ASM ka. Next, quick ratio. Earlier, we were not much bothered about quick ratio, but last year, our bank has given guide, Reserve Bank has given guideline that you take while assessing limits, quick ratio also, especially for working capital limits, quick ratio also you consider. So desirable level, they have given so much big list it is given for each industry, separate quick ratio levels it is given. But applicability only we will see. Whom it is applicable? It is in respect of MSME borrowers with total exposure above 10 crores, MSME borrowers, and non-SME, other than SME, haito, above 50 crores. This quick ratio you have to consider. Below that levels, you need not worry. And ratios also it is given varying from 0.6 to 0.093, basing on type of industry. That ratios it is given, we have to follow. So now for quick ratio, applicability, remember, above 10 crores for SME, above 50 crores for non-SME, other than SME. Next, compliance of terms and sanctions. Normally we mention in NF 482, it is a common guideline. Next, fixation of time schedule for working capital limits. Earlier working capital limits, we used to say 12 months, 18 months, and 24 months for SME like that. But now bank has given uniform guideline that maximum period of working capital is fixed at 12 months only. Only exception it is given staff OD, GLOD, crop loan KCC, and certain schematic lending like retail lending may doctor's choice is there, where 2 years it is given working capital go. So like that, some exceptions are there. Otherwise, uniformly, it is 12 months is fixed working capital limits ka tenability, right? Of course, extension is there that we will discuss separately. Next, putting through EMT or mortgage transactions. Normally, while sanctioning term loans or big loans, what we say, mortgage is to be created within so and so time. In some cases, what happens is documents may not come or some problems will be there. In such cases, there may be delay while creating mortgage. So creating mortgage means security problem we high. Normally, we will monitor very closely. So EMT is to be generally mortgage. In case of retail lending takeover, also housing loans, we say within 30 days EMT is to be created. We'll say like that. So here at the time of sanction, for creation of mortgage, time will be given. For any genuine reasons, if EMT is not created, then sanctioning authority may give first extension 6 months and again another extension maximum 6 months they will give. And subsequent extension aa gaya to then next higher authority ko jana padta. This is what EMT, putting through EMT transactions. Next, LSDBC, Purana Dino mein very important question. Now also frequently they are asking. Loan system for delivery of bank credit, LSDBC we call. Why this LSDBC has come, I will tell you for understanding. Reserve Bank has observed one thing, that suppose you have sanctioned 500 crores working capital limits to a borrower. 500 crores because he is a good triple A rated company, you have sanctioned. But borrower is not availing. Only 10 crores or 50 crores only that fellow is availing. But your sanction is 500 crores. So remaining 450 crores unavailed portion is there. You cannot lend to others because your asset liability mismatch will come. So in such cases, what Reserve Bank says, if that 450 crores loan is given to some other fellow, productivity purpose वो utilize करेगा, interest भी आएगा, economy बढ़ेगा. So why you waste unnecessarily bank money blocking for good people who do not avail full limits. So to safeguard such problems, to overcome such problems, what Reserve Bank has told is, wherever borrowers are enjoying working capital limits of 150 crores and above, in such cases, you bifurcate that limit. How you bifurcate? At least 60% you divide as working capital demand loan. It is called as WCDL. Working capital demand loan means we will disburse loan today, just like DPN loan. Party has to repay after fixed period. So here working capital demand loan, it varies from 7 days onwards. Minimum component is 7 days. 7 days to up to 1 year. 1 year, why we are telling working capital limits are valid for 1 year. So minimum 7 days and maximum up to tenability of the limits. This he can avail. Working capital demand loan. So that you will have an idea, party is availing limits up to some extent. And remaining 60 ho gaya working capital demand loan. Beyond this, you give CC, cash credit limit. So up to 60% working capital demand loan and remaining maximum up to 40%, it will be in the form of CC. So divide wherever working capital limits are given, 150 crores and above from banking system, divide it. 60% should be in the form of working capital demand loan and remaining amount may be in the form of cash credit. And tenability, minimum tenability of working capital demand loan is 7 days, maximum up to validity period of working capital. Now, risk weight for undrawn portion as on balance sheet date, risk weight for undrawn portion. Party out of 150 crores, party might have availed only 50 crores total. Remaining 100 crores, whatever unavailed portion is there, for that you have to charge on 20% capital is to be charged. So risk weight is given 20%. That means, for example, I will tell you 150 crores is limit, 50 crores is availed, 100 crores is unavailed. On 100 crores, don't take full 100 crores for capital calculation. You take 20%. That means 20 crores is taken for capital purpose. 11.5% capital. Only for 20 crores you calculate 11.5 crores capital. This is what risk weight for undrawn portion. Normally, if undrawn means for calculation of capital, 0 it will come. Only 50 crores is availed. Liability we take 50 crores and 50 crores only we maintain capital. But Reserve Bank says on undrawn portion also you maintain capital. So here undrawn portion is 100 crores, 20% conversion factor. So on 20 crores you maintain capital. This is what risk weight for undrawn portion at the rate of 20%. This is briefly LSDBC because several times repeated question. Loan system for delivery of bank credit. For drawing power, normally what we do, total stocks minus sundry creditors for goods. We deduct from stocks. Then paid stocks will come. On paid stocks, we calculate less margin, drawing power is arrived. But in some cases, you need not deduct sundry creditors for goods up to accepted level at the time of sanction. This is subject to concurrence by permission by GM, HO, CSC and above. So what is this accepted level? I will tell you. 100 crores is stock. 100 crores is your stock. And out of that, 20 crores is sundry creditors for goods. Normally, this 20 crores you have to deduct. But at the time of processing the loan, sundry creditors level was 20 crores or 25 crores. So at the time of sanctioning, 20 or 25 crores you have accepted sundry creditors. So accepted level sundry creditors, you need not deduct from stocks for drawing power. So in this example, 100 crores is stocks, 20 crores is sundry creditor. Already sundry creditors at the time of sanction, 25 crores was outstanding. So you need not deduct this 20 crores from stocks. That means on the entire 100 crores, you less margin, you give drawing power. You need not deduct sundry creditors up to accepted level at the time of sanction for arriving drawing power only. This is what computational drawing power. With the GM, HO, CSC authorities, you need not deduct sundry creditors. This is the question, right? Next, we go for term loans. Term loans, DPG, bills co-acceptance for capital goods, all are under term loans assessment. DPG means deferred payment guarantee. DPG. Earlier, somebody I think asked CRAR abbreviation. CRAR means capital to risk weighted assets ratio. Capital to risk weighted assets ratio. They are nothing but capital ratio. CRAR or CAR or simply CR. Both are same terminologies. Capital to risk weighted assets ratio or capital adequacy ratio or capital ratio. All are similar terms only. Right? Now, similarly, term loans, DPG means deferred payment guarantees. What is deferred payment guarantee? Deferred payment guarantee means somebody is purchasing machinery from a supplier. So the machinery supplier, he may says every year you pay certain amount. Say machinery cost is 100 crores. First year you pay 20 crores. Remaining 80 crores, you arrange DPG from your bank, deferred payment guarantee. Every year 20 crores, like that 4 years he has to pay. For 4 years we give DPG. What this DPG says, next year 20 crores if our borrower is not paying, we will pay on behalf of bank, we will pay. This is what guarantee given to supplier of machinery. So basing on our guarantee, supplier will supply machinery to this borrower. That we can give loan. When we give loan, it is called as term loan. Or DPG, if you give deferred payment guarantee, when deferred payment guarantee will be given, if supplier is agreeable to take amount in installments, then DPG is given. So next year 20 crores, if borrower is not paying, we will pay. Afterwards, another 20 crores, if he pays, okay, otherwise we will pay. This is what contingent liability DPGs, right? Next definition, mostly 1 to 2 May, they are asking about the definitions. Term loans, all term loans with maturity in excess of 1 year, it is general term. Medium term loans means repayable in more than 1 year up to 3 years, and long term loans above 3 years, right? Again, in agriculture, some medium term loans 3 to 5 years will come norms. Now it is RBI's definition. Next, while considering infrastructure proposals, mechanisms like escrow, creation of debt service reserve accounts, monitoring cash flows through trust and retention accounts, and appointment of lenders, independent engineers, etc., should be explored to ensure better access and control on project cash flows, which will be utilized by way of documented waterfall mechanism in the escrow or TRA account. Here, so many terminologies are there. I will explain you in detail what is this terminology one by one. What is escrow? What is trust and retention account? I will discuss. Then we come for escrow account. So these are all, instead of studying, I will tell you. In escrow mechanism, there will be 4 people. I will tell you through example here. For instance, if you go through this example, you will understand what is escrow mechanism. For instance, a power plant. Somebody is coming and says, sir, I am going to construct a power plant. After construction of this power plant, I will supply this, my power, to electricity board, state electricity board. Then he will come for bank. We will finance with that person. And power plant will be constructed, and he will sell power to state electricity board. State electricity board, in turn to its customers, consumers, it will supply and collect amount from consumers, and then it will pay to borrower, our borrower, because whom we are giving loan, that power plant owner, we are giving. So here what they say is, here cash flows are there. These cash flows, if borrower is having access over these cash flows, tomorrow we don't know whether that fellow will pay to us or not. And state electricity board also, whether all the revenues, whatever they are collecting from customers, whether they will give it to the our borrower, power plant person or not, these are uncertain. To overcome this, separate account is created, which is called as escrow account. For particular purpose, account is created, escrow account. it will be opened with one bank, which is called as escrow agent. Escrow agent. Here, escrow agent is a bank. That bank will open account. All monies, whatever cash flows are there, first it will be credited to escrow account. From there only, amount will be utilized as per escrow arrangement. As per escrow arrangement. So here, 4 parties are involved in this. One is our borrower. Second one is banker or lenders. Second one. Third one is escrow agent or another bank. And fourth one is state electricity board, which is customer of our borrower. Customer of our project, power project ko customer, state electricity board. So 4 people are involved in this. All cash flows, whatever credited to this account, it will be utilized in an agreed manner. How it will be utilized? It is again called as waterfall mechanism, either for escrow account or TRA. Next I will discuss TRA also. Both escrow and TRA accounts may waterfall mechanism we call how funds will be utilized. Funds first they will utilize for O&M. O&M means operations and managing the unit, management of the unit operations. Because usko power chahiye, workers chahiye, so many expenditure will be there. Otherwise, plant will not run. So O&M first they will give priority. First, cash flows will be given to operations and maintenance. Second, any government dues or taxes will be paid. And third, our bank dues, if any, it will be paid. Then only bach gaya, that amount will be given to our borrower as per his utilization, whatever it is. So since all these funds are in a bank, which is called as escrow agent bank, escrow account is opened in a bank, and all these funds are credited there, their utilization will be as per this priority. So here escrow arrangement or agreement will be there. In this agreement, all 4 people will sign and funds will be utilized in the waterfall mechanism. This is called escrow account. And the second one account I will tell you, TRA, trust and retention account. Escrow account में borrower का interest is there. Here trust and retention account में bankers का interest is taken care. How bankers का interest is taken care? Escrow में. This is also similar to escrow, trust and retention also. But here only 3 people will be there. Lender, that is banker. Second one is borrower, our customer. Third one is TRA agent. TRA agent is again a banker. So here tripartite agreement will be there. Here also all funds will be credited to that trust and retention account. Whatever funds are received. Here, for example, I will tell you road project is there. Road project, our borrower will, one borrower will come and approach us. We will sanction loan to the borrower. He will construct road and he will collect toll collections. These toll collections are credited to TRA account, trust and retention account. So from TRA account again, waterfall mechanism. First to operation and maintenance, second to government dues, third to our dues. Our dues ke baad we will part it with our borrower. He will utilize. So this is how all funds flows are controlled in term loans in these 2 type of mechanisms. Escrow mechanism, TRA, trust and retention account mechanism. So difference is escrow में 4 parties, TR में 3 parties होता. Escrow will take care of borrower's interest. TRA account will take care of our banker's interest. This is the difference. Otherwise, both are same types of mechanism only. So this is called as TRA mechanism. So now we go for our term loans में. Sorry, term loans का. Infrastructure project or any escrow mechanism already discussed. TR trust and return. Debt service account. Debt service account means while sanctioning term loans as a precautionary measure, bankers will prescribe amount equal to 3 monthly installments or 1 quarterly installments or maybe more installment with mutual agreement. Minimum I am telling. Equal to 3 monthly installments or 1 quarterly installment. You keep separately either in the form of KDR or separate account. It is called as DSRA account, debt service reserve account. What is the purpose of this account? If for any reason, if borrower is not in a position to pay any installment, then we take from this debt service reserve account that amount and adjust to our loan so that account will not become NPA. This is to safeguard the interest. This also, in case of term loans, we will prescribe equal to 3 months or 1 quarterly installment. Separately, sometimes party says, sir, immediately I don't have money. I will create DSRA once my commercial operations are started. Okay, at the time, what we will do? TRA account, say, yeah, escrow account, whatever they are opening, from that account, whatever cash flows are coming, some 2% or 3%, some amount we will credit to DSRA and create subsequently. This is what DSRA account. Lender's independent engineer. Next one. Lender's independent engineer means for road projects, for example, they will be laying road somewhere and we are, say, we are in Hyderabad and we are funding. Road is somewhere in Haryana or Punjab. There our borrower is laying road. So who will go and supervise continuously whether that fellow is utilizing or not? We don't know. For that purpose, what we will do, all lending banks, they will appoint one engineering firm who are experts in that line. On behalf of lenders, we appoint, they called as lenders independent engineers. So they observe what is the progress going on, whether utilization is going on or not. They report to the lenders. And amount will be paid by borrower. Their lenders fees, whatever it is there, engineers ka borrower will pay, but they work on our behalf for monitoring or supervision. This is what we call as lenders, independent engineers to supervise end use of our funds. Right. Wonderful mechanism. This is over. These are all terminologies in our term loans for understanding purpose I have discussed. Next, hybrid annuity model. This is also a little higher level. They are asking question. Even interviews also they ask. That is why, well, just fastly, briefly, I will discuss what is this hybrid annuity model. Normally, BOT means built, operate, and transit. Road projects, I will tell you, for example, road projects may, earlier I told you, our borrower is there in Hyderabad. We have sanctioned loans. He is constructing road in Punjab or Haryana, whatever it is at that place. Party is constructing road. So here what national highway authorities will do, they will give contract to our customer. They have given contract to our customer. Our customer, he will build road and operate it for 30 years. Then transfer it to the government. So these 30 years, party will collect toll collections and these toll collections will be created to TRA account. From there, we will receive our repayments. So this is how BOT will work normally. Engineering, procurement, and we call them as EPC contractors. Engineering, procurement, and construction, they will do everything they will do. But some other model is there where annuity model we call. Annuity model mein kya hai? Government will give some amount. First, government will give some amount. Say 40% first government will give till construction and 60% they will raise loans. Borrower will raise. Also, we will finance up to 60%. Government will give 40%. So our 60% of loan, how they will repay? After completion of road, every year or half yearly, government will pay to our customer. It is called annuity. And toll collections may be in the hands of borrower or in the hands of party. It doesn't matter because it is agreement between them. Government will pay annuities. Those annuities will take care of our repayment installments. So this is called annuity model. Annuity model. Then hybrid annuity mein kya hai? We are funding something and the government is also financing something. Both put together, party is constructing road. And subsequently, through annuities, party will pay to us. This is what hybrid annuity model. Some portion government, some portion by banks. Subsequently, through annuities, party will pay to us. So mostly these type of projects are useful in case of stalled projects or where projects are not having that much demand. Toll collection zyada nahi hai to such type of roads, it will be given under hybrid annuity model, right? Next one, tail risk, another point. Term loans may, this is another issue. Tail risk means, earlier example we will take, one road project, 30 years repayment, 30 years project total, uska period we call, concession period we call. So National Highway told 30 years you operate and after 30 years you transfer to us. That means up to 30 years income will be generated. So what we do while fixing repayment, don't fix up to 30 years. You leave some period, say last 25 years or 20 years only we fix repayment. You leave some period. That is called a tail period. Till end don't period repayment, because so afterwards you may restructure. Suppose you have fixed for 30 years. After some time it is restructured. In restructuring, another 5 years extended repayment. So 35 years तक ये economic life नहीं है. Government को 30 years को transfer करना. So there may not be period. That is why to safeguard this, what they say is, don't fix repayment for entire 30 years. You fix for 20 or 25 years. You leave some tail period without fixing repayment. That is called tail period. This tail period here, 25% in case of it is non-infra projects and 20% in case of infra and industries. That means if total economic life is 20 years, suppose, so economic life is 20 years, you leave 25%. That means 15 years only you fix repayment in case of non-infra and 20% chhod diya to 4 years leave karna, 16 years only repayment you fix for infrastructure projects. So this is what tail risk, to safeguard from tail risk. And one more guideline here, what they say is, first 75% of repayment, whatever it is there, it should be completed within first 75% of repayment period. At a 75% of loan is to be cleared within first 75% of repayment. I will tell you example. 20 years is total repayment period. Out of 20 years, loan is 200 crores. 20 years is repayment, loan is 200 crores. So 75% of loan is to be cleared within 75% of period. That means 200 crores may 75% is 150. 150 crores loan is to be repaid within 75% of period. 20 years may 15 years. So 150 crores of loan is to be cleared within first 15 years. Right. This is to safeguard tail risk. So 2 types here. Okay. Only for higher level you think of this. Next we go for next one. In case of restructuring, 20% or 15% tail risk, it is reduced here. Reimbursement under term loans. This is another recalled question. Reimbursement under term loans normally permitted up to maximum 25% of the loan quantum or investment of the borrower in plant and machinery, not investment in others. The maximum quantum is 25% of the loan or investment in plant and machinery. Next, low risk party. Reimbursement is permitted only for plant and machinery, not for land and building. Next, reimbursement should be claimed within 6 months only from the date of incurring or from the date of purchase. Then bills, stamp, receipts, inspection, everything, normal guidelines. So here in reimbursement, we have 2 types. One is 25% of loan amount or investment made in plant and machinery. This is annual review of term loans. Annual review of term loans, it is applicable for term loans sanctioned by CO head, CAC and above authorities. Earlier they have prescribed 5 crores. Now 5 crores, instead of 5 crores they are telling term loans sanctioned by circle head, CAC and above authorities. It is annual review of term loans. And what are the loans eligible? Standard restructured, NPA not marked for recovery. These are eligible accounts for annual review of term loans. And retail loans up to 5 crores exempted. They need not up to 5 crores. Retail loans not subjected to annual review. In case of standalone term loans, that means exclusive term loans, they are working capital not enjoying parties. Standalone term loans. In such cases, yearly review we will do. In case of working capital also enjoying means at the time of renewal of working capital, this review also will be done. This is when it is to be done, right? Next, project appraisal. This is also frequently recalled question. What is this project appraisal? In case of term loans, big loans, party will submit our project report. This project report is to be appraised by two types here. because in branches we may not have expertise. So for this purpose, separately, project appraisal cell is created at circle office and the project appraisal group is created at head office. These two will do appraisals. And what are the loans eligible for appraisal? New borrowers. In case of new borrowers, with project cost 500 lakhs and above, 5 crores and above, new borrowers. That proposal is to be appraised by our project appraisal cell or group. Next, for existing borrowers, project cost 5 crores and above for moderate risk rating people, and low risk and normal risk aito 10 crores and above, existing borrowers. Low risk and normal risk 10 crores and above, moderate risk 5 crores and above. Project is to be appraised by our project appraisal cell or project appraisal group. Then only we will take up this proposal. If they say it is viable, yes, we will take up. This is what project appraisal. Next, commercial real estate. Earlier we have seen CRE may all projects irrespective of project cost, they are subjected to project appraisal. But one exclusion for CRE RH I told, up to 5 crores CRE RH is exempted. Otherwise CRE all projects. Who will do approval of project appraisal? DGM CO in case of PSC or PFD at CO circle office level, DGM CO. In case of head office project appraisal group kiya to, their DGM of HO. They will approve the project appraisal report. In case of agricultural term loans, AIC, Agricultural Innovation Center. Earlier we call it as Agricultural Consultancy Services at head office. Now it is renamed as Agricultural Innovation Center at head office. They will do for agricultural term loans. Here, what is the cutoff limit here? New customers with project cost above 2 crores. Existing customers with project cost above 5 crores. This Agricultural Innovation Center will do for agricultural term loans. So this project appraisal, several times they are asking question, very important for exam. Next, irrespective of sanctioning authority, project appraisal cell at circle shall conduct appraisal of term loans as under. Here who has to do? Whether head office has to do or circle office has to do. This is the question. CGM or GM headed circles, project cost up to 100 crores, PAC will do, beyond that PAG. DGM headed circles, project cost up to 50 crores, circle will do, beyond that head office, PAG. Next, banks may utilize external empaneled people also. We call TEV consultants. These are technically evaluating TEV consultants. So their services also we can utilize, but for project cost up to 250 crores only, we can utilize outsourcing. Beyond 250 crores, our own people, PAG at HO, they have to do project appraisal. This is project appraisal. Now this benchmark ratios, here what important thing I will do, mostly in exams they are asking either debt equity ratio or debt service coverage ratio or FACR, and very rarely this one actually. Prepayment also rarely coming. These three ratios very frequently in exam they are asking. Here, debt equity ratio, if see transport operators 3:1, it can be reduced to 4:1 by next higher authority. Next, project cost up to 100 lakhs, 4:1 debt equity ratio. PC above 100 lakhs, either 3:1 or it can be reduced to 4:1. Agriculture 3:1, 5.66 for projects up to 10 lakhs only. And below, infra, below 5.67:1. Infra only differing. Remaining all generally 3:1 or it can be reduced to 4:1. This is about debt equity ratio. Debt equity ratio means debt divided by equity. Debt is long-term debt. In other words, long-term loans divided by tangible net worth. That is what equity. Long-term loans divided by tangible net worth. This is what debt equity ratio equation and ratios, prescribed ratios. Debt service coverage ratio. Debt service coverage ratio means here equation is profit after tax plus depreciation plus interest on term loans divided by interest on term loans and installments on term loans. This is what, in other words, we call it as surplus divided by commitment. What is surplus? Profit after tax plus interest on term loan plus installment on loan plus depreciation. That is what surplus divided by commitment is interest on term loans and installments on term loan. So the equation is generally 1.5. Earlier also I told you, always wherever they are asking DSCR, blindly you remember it is 1.25 generally. Only thing is next higher authorities, sometimes they may accept up to 1.25 or 1.40. Agriculture 1.25, infra 1.25, otherwise PC big projects 1.40, otherwise it is 1.50. This is DSCR, debt service coverage ratio. Fixed assets coverage ratio, FACR, is nothing but fixed assets divided by long-term loans. Fixed assets total divided by long-term loans. This is equation for this. So generally fixed assets long-term loans se zyada hona, because party will purchase fixed assets out of our term loans and margin will be there. For example, I will tell you 10 crores fixed assets party has purchased. 25% is margin. So what we say fixed assets coverage ratio, 25% margin means 75% is loan. So 10 crores fixed assets के लिए 7.5 crores is loan. So fixed assets ratio, fixed assets divided by loan. 10 crores is fixed asset, loan is 7.5 crores because 25% margin बोला था ना, 7.5 crores is loan. So 10 divided by 7.5, it is 1.33. That is simple for remembering how 1.33 fixed assets ratio fixed. So margin should be at least 25%. And small units के लिए it can be reduced up to 1.20. This 2-3 times he asked, 2 to 3 I think they asked, what is fixed assets ratio for project up to 100 lakhs? Up to 100 lakhs 1.33, it can be reduced to 1.20. Above 100 lakhs also 1.33 can be reduced to 1.20 or 1.25. Agriculture minimum 1.25, infra may 1.25, it can be reduced to 1.11. This is fixed assets coverage ratio. And repayment here, repayment may generally transport operator 6 years and up to 100 lakhs, 1 crore tak 7 years, and up to 10 years also it can be. Above 100 crores 7 to 10 years, and up to 12 crores also. Agriculture 5 to 7 years, 15 years for plantation. Infra 15 years, it can be extended to 20 years also. Margin generally up to small units के लिए up to 1 crore 20%. Above the minimum 20%. Agri minimum 15% margin, and infra 15%, 11% if government stake is there. Infra may. IRR, internal rate of return. Internal rate of return means today we are investing, say today we are investing 100 crores. This 100 crores within how many years it will come back, at what rate it will come. For example, I will tell you, today you are investing, entire this 100 crores will come in 10 years. That means approximately at the rate of 10% it is coming. It is blindly I am telling, but not exactly 10%, because IRR will be calculated at net present value basis. So today you are investing 100 crores, next year you will receive 10 crores. Next year 10 crores is not equal to 10 crores today. So it will be equal to 9.75 crores. Like that it will be calculated in Excel, and IRR will be arrived at what rate. So what is the rate? 4% above weighted average cost of funds. Weighted average cost of funds means approximately cost of funds. So normally cost of funds, earlier we have seen our bank balance sheet may cost of funds is about 4.5%, something is there. That is cost of funds. So 4% above means 8.5% at least it should be there IRR. Then only we call it as viable and we accept for financial parameter. So IRR, you have to remember only thing is applicability. Applicability is above 25 crores only. Above 25 crores only. Agriculture also it is applicable, infra also applicable. So here that is why it is given IRR project cost above 20 crores and up, 25 crores and above. And always it is 4% above weighted average cost of funds. Always. Only 2% for road projects. 2% above weighted average cost of funds for road projects. So these are term loan parameters. It is given by bank in our policy. Strictly it is to be followed. IDC, interest during construction. It is Project cost may it is part, but we will not fund interest during construction. Party has to bring from margin only. Next, minimum equity contribution by promoter shall be 50% of overall margin over the project. How it is 50% of the overall project, I will tell you. Say, project is 100 crores project party. There we say 25% is margin. 100 crores का project, 25% margin means वो 25 crores उसका margin होना. Out of 25 crores, आधा उसका funds होता, remaining 50% he may raise outside. Where raise outside, we call it as long-term borrowings or outside borrowings or subordinated debts. Subordinated debt means raised from outside but repayable after 12 years where there is subordination agreement. What is the subordination agreement? The lenders of this party, they also will enter into agreement with the banker, tripartite agreement. Bank, our borrower, and the lender of that borrower. All three will execute an agreement which is called a subordination agreement, wherein the lender says that up to 12 years minimum we will not ask without consent of bank, we will not demand repayment from this borrower. This is what subordination agreement. If such a subordination agreement is there, that outside borrowings are called as quasi-equity. Quasi-equity. Outside borrowings with subordination or repayable in more than 12 years are called as quasi-equity. Always quasi-equity should be less than own equity. This is the equation. Always quasi-equity should be less than equity. Our equity should be more, quasi-equity should be less. Our equity should be minimum 50% and quasi-equity maximum 50%. That is why here minimum equity contribution by promoter shall be 50% of overall margin. I told you 25 crores is total margin. उसमें minimum 12.5 crores party का own funds होना, remaining maximum 12.5 crores party may bring outside borrowings. This is project में, but this is applicable for 50 crores and above quasi-equity. And maximum cap of quasi-equity should be 100% of equity. That means हमारा पैसा से ज़्यादा बाहर का पैसा नहीं होना. This is what maximum 100% of equity. So, if quasi-equity is withdrawn later, subordination agreement already executed, but subsequently party has withdrawn, then your margin has come down. Then your ratios also will be adverse. Ratios also will be adverse. Debt equity ratio, it will be more than accepted level. Your TOLST, TNW, ये भी बढ़ जाएगा because tangible net worth has come down. So in such cases, 1% additional interest is to be charged. Okay. Next, delegation of powers by taking any fresh exposure, additional exposure. Gems and jewelry, I will not concentrate much on this. We will skip it. 2, 3. Who has to sanction? For discoms means electricity board का होता है ना. For discoms, working capital shall be restricted to 25% of their total revenue as per audited balance sheet. Discoms के लिए लोन देने के समय working capital limit maximum 25% of the total revenue as per audited balance sheet. And in case of Genco, this is also electricity department, Genco and Transco, working capital is restricted to 50% of total revenue as per audited balance sheet. This is about working capital ka. Takeover of borrowers, this is also one important aspect and recalled questions are there. Takeover of borrower accounts from other banks or financial institutions. Normally, here the condition is, after, suppose if party approaches our bank after 3 months of closing account with other bank, 3 महीने के बाद आया तो closing करने के समय, it is not treated as takeover, it is normal. Similarly, retail lending के लिए और agricultural loans other than food and agro processing है ना, वो तो बड़ा loans 100 crores and above priority, up to 100 crores it is priority. So those loans के लिए this is not applicable. वो retail lending and agricultural loans के लिए 10 दिन के बाद आया तो वहां क्लोज करके दूसरे बैंक में क्लोज करके after 10 days party has approached, then we don't call it as takeover. So normally after 3 months in case of other advances, after 10 days in case of retail and agriculture, we don't call it as takeover, we consider this as a fresh finance. So takeover norms are applicable for them, not applicable for them. What is the takeover policy? Exposure here up to 100 crores or agriculture and retail small loans के लिए account should be rated as BBB and above. This is rated for MSME. BB and above also acceptable. This is for takeover के लिए. Minimum rating should be BBB and above. For SME it is BB and above. And 3 years profit earning, financial parameters satisfactory, previous 1 year may not restructured, not SMA 2 in previous 1 year, no downgradation of external rating. These are all common guidelines for takeover. And other guidelines may, the account should have been in the books of transferor bank at least for 1 year and 6 months at least with the previous bank in case of low risk and A and above rated borrowers. That means at least 1 year it should be with other bank, previous bank. And 6 months in case of low risk wala. In case of manufacturing units, minimum 1 year old should have satisfactory repayment track record for at least 6 months. And the DCCO, commencement of commercial operations, at least 6 महीने से ज़्यादा हो गया, more than 6 months back commercial operation. This is for manufacturing unit. So minimum 1 year old should have satisfactory repayment track record at least 6 months. DCCO 6 महीने से पहले ज़्यादा ही हो गया. Then only manufacturing unit we will consider for takeover. Shifting of account from other banks shall not be more than one occasion during last 5 years. At least पिछले 5 साल में एक साल, not more than one occasion, that is shifting. And the gap to last switchover shall be minimum 1 year gap to last switchover and 2 years for big corporates. Minimum gap from previous switchover. 2 years in case of that means there should not be frequent switchovers. So at least it should run with the previous bank for 1 year. In case of big corporates, 2 years it should run. Then only it is eligible for takeover. Next, audited financials for 2 years at least you have to take. For corporates, minimum 3 years you have to take. And compare with ROC. This I told you, whenever ABS is taken, you have to compare with ROC website. Current ratio 1.33 or 1.25. It is normal ratios only. But for MSME, current ratio relaxed up to 1, which is recalled question. For current MSME, current ratio is relaxed up to 1. Up to 1 current ratio you can take over, including 1. Debt equity ratio not more than 2:1 and relaxations up to 3:1. For MSME also it is 3:1 debt equity ratio. Pass sheet for 1 year in case of term loans and 6 months in case of working capital to be verified. For term loans, time overrun or cost overrun is more than 15%, no takeover. Time overrun means वो तो कंस्ट्रक्शन पूरा टर्म लोन्स एनी इंडस्ट्री कंस्ट्रक्शन के लिए वो बोलेगा 2 साल लगेगा, बट 2 साल से ज्यादा हो गया, मोर देन 15%, 2 साल से ज्यादा हो गया, 2.5 साल, 2.5 years हो गया, दैट मीन्स 25% exceeded, then no takeover. Similarly, cost overrun, project cost is 10 crores, but now it has become 14 crores, 40% बढ़ गया, ये 15% से ज्यादा बढ़ गया तो no takeover because cost overrun is 40%. It will not be taken over. Only 15% tak permissible. Cost overrun or time overrun. Next, dilution of security should not be there. Whatever securities are given, same securities they have to give, or at least equal amount they have to give. Reduction in margin should not occur on account of takeover. No reduction of margin. What happens? Reduction of margin kiya to then it will become restructuring. Next, for takeover with enhancement, suppose normally whatever liability is there, that is to be taken over. But party says, sir, thoda zyada bhi de do loan with enhancement. Their security coverage in the form of land and building, our own bank deposits, NSC, KVP, insurance policy, etc., not less than 50% of the entire exposure, including enhancement. Suppose 10 crores you are taking over, another 2 crores it is added. In such case, all the securities may, full security it is required, but at least 50% should be in the form of approved securities or land and building. And vacant land not more than 50% of total collateral security. This is general guideline. Vacant land not more than 50% of total collateral security. But in case of MSME schemes, in many schemes, vacant land should not be more than 25%. Here it is general condition. Normally vacant land not more than 50% of total collateral security. This is for takeover. If enhancement is more than 25%, then sanctioned by next higher authority. This is for sanctioning. HO power accounts more than 25% or whatever may be enhancement, then same authority, HO, GM, CGM, CGM, HO and above. If fresh term loans are proposed for expansion during takeover, respective sanction. Suppose during takeover, party says, I want extra amount. Extra amount we says it is more than 25% means it is next higher authority. But if party is proposing expansion, additional machinery purchasing, or additionally expanding business, in such case, the respective sanctioning authority can sanction. Next, expansion के साथ साथ some concessions also asking party rate of interest or service charges. Then next higher authority को जाना पड़ता up to CO head CSC. HO power accounts है तो HO same authority will do. Next, proposal with enhancement. If collateral is more than 100% of exposure, including enhancement, at least 15% of collateral should be in the form of commercial or residential properties. Wherever proposal with enhancement is there, collateral normally it should be more than 100%. Then only we will enhance. So in collateral security, minimum 15% should be commercial or residential properties. Minimum 15%. So earlier it told, including all commercial residential properties plus approved securities should be minimum 50%. Here exclusively commercial and residential properties 15%. Including approved securities minimum 50%. That you have to keep in mind. Next, stock audit to be conducted. Waiver for stock audit, secured OD limits, contract OD scheme. Now waiver of stock audit also, whenever takeover is there, normally stock audit is to be conducted. But when we waive up to 10 crores, we can waive provided previous bank say stock audit statement jo hai wo de diya. That statement is not more than 6 months old. पिछले बैंक जो from which bank party is coming, वो बैंक से स्टॉक ऑडिट वो तो 6 महीने से के अंदर ही स्टॉक ऑडिट हो गया, तो स्टॉक ऑडिट रिपोर्ट दिया. In that case, up to 10 crores we need not conduct again stock audit. If more than 6 months हो गया तो 3 crore तक stock audit waiver is there. But wherever stock audit waiver is there, 3 महीने का stock statements you have to collect and scrutinize. This is regarding stock audit waiver. In case of MSMEs, up to 1 crore, CO head may permit waiver of stock audit provided 125% collateral comfort is available. This is for stock audit waiver in case of takeover may. Next, sanction communication of last 3 years. 1 year in case of agriculture loans, it should be verified. Takeover from bank where our whole-time director worked earlier. In that case, sanctioned by GM, HO, CSC and above. Because Section 19, subsection 3 of Banking Regulation Act prohibits here. Restrictions are there. Wherever our directors earlier worked in other banks, there you should not take over. So here guidelines GM, HO, CSC and above they can say. Right. Retail loans may just only broad guidelines we will go through. Satisfactory conduct in the previous bank at least for 1 year. Prompt payments out of 1 year may at least 6 months promptly we should have paid. Then only they are eligible. And risk grade CRG 3 moderate risk and good and better rating then only we can take over. Next, where projects are not completed, not fully disbursed, not eligible for takeover. Normally, repayment period also, whatever remaining repayment period is there with the previous bank, same repayment period only you have to give. You should not extend the repayment period. Only exception is lease discounting proposals, wherever it is there. Their repayment can be extended. Within maximum permitted period is 15 years, that is 180 months. So within that 180 months, you can permit for only for lease discounting proposals, not for others. So in case of other loans, same repayment period you have to give. Next, valid EMT should be created within 30 days. This is for retail loans, I have told you. Now, in case of restrictions for lending is there. Advances against our own bank shares, no question, because our own bank shares we should not lend. This is one guideline. Next, no loans to companies for buyback of their own shares, not. This is important, third one. Several times repeated question. This is very frequently asking. Section 19, subsection 2 of Banking Regulation Act says, we should not hold shares in any company except as provided in subsection 1, whether as a pledgee, mortgagee, or absolute owner of an amount exceeding 30% of that paid up share capital or 30% of our own share capital and reserves. So, exceeding 30% of their capital or our capital, we should not sanction even loans against a particular company as a pledgee or mortgagee or so. That is why loans against shares may, whenever against any particular company shares 20% तक आ गया तो threshold limit, immediately bank will exercise caution because it should not exceed 30%. So whenever it reaches threshold of 20%, bank will give immediately, don't sanction loans against a particular company because it is already crossing RBI's prescribed limit. That guideline they will give. So 30% of our share or 30% of their share paid capital and reserves, it should not exceed. This is the norm. Very important for all exams. Section 19(3), I told you, BR Act का जब भी any director earlier has worked in that case also normally it should be restricted, avoided. Next, selective credit commodities. SEC commodity means essential credit commodities against rice, wheat, so and so, sugar, oils, cotton. Against essential commodities, don't sanction liberally. There are certain guidelines are there. These are called as selective credit control commodities. At present, only levy sugar is there, remaining all removed from SEC list. Only levy sugar is there. There also minimum margin 10% we have to apply. This is SEC commodities. Next, against banks, दूसरा बैंक का टर्म डिपॉजिट्स के ऊपर we should not sanction loans, but we can keep as collateral with the DGM permission. Banks are not allowed to grant loans against certificate of deposits. CDs के against no loans. Partly paid shares against also no loans. And other than individuals को primary security of shares and debentures उसके ऊपर भी no loans. Purchase of gold coins or gold bullion means bars or biscuits. Don't keep it for security. Only coins up to 50 grams sold by banks you can consider for gold loans. Against other, you should not sanction. Against bars or billion, what is that? Coins or bars or biscuits, against gold biscuits, no loans. Only ornaments we will keep for gold loan purpose. Up to 50 grams coins sold by banks also we will consider as security for gold loans. Next, गवर्नमेंट ऑफिसेस के लिए अपने के लिए कंस्ट्रक्ट किया तो फॉर सेल्फ यूज कंस्ट्रक्ट किया तो नो लोन्स गवर्नमेंट डिपार्टमेंट्स फॉर ओन बिल्डिंग्स. नेक्स्ट, नो लोन्स फॉर ओजोन डिप्लीटिंग सब्सटेंसेस. These are all like refrigerators, something, their ozone depleting substances will be there. Against those, we should not lend. Their guidelines are there. No loans for acquiring Kishi Vikas Patra, Kisan Vikas Patras, etc. Next, normally no bridge loans. Bridge loans means against expected some receivables, but banks are permitted to sanction bridge loans to companies for a period not exceeding 1 year against expected equity flows or issues. Somebody has gone for primary issue or subsequent issue. There they are expecting some funds out of equity issues. There against that receivables we can sanction bridge loans. Bridge loans against receivables. Next, Indian depository receipts against also no loans. What are these Indian depository receipts? Suppose foreign companies, they want to raise funds in Indian market. They issue shares to Indian market. Against those shares, we should not subscribe. Those shares are kept with one security depository in India. and they issue receipts against particular shares. They are called as Indian depository receipts. So against those receipts also, in nothing but shares of foreign companies. So we should not lend. Next, regarding variations, earlier I told you some ratios I have given, and we have to follow those ratios at the time of sanctioning loans. But there may be some variations. Particular ratio, suppose margin is there. Margin 25% we have prescribed. Party says, no, I can give only 15% margin. So that is variation. Like that, how many variations we can overlook? Overlook ka matlab, consider even variations are there. Here GMHOCAC, they may permit 2 variations. EDCAC up to 4 variations. Beyond 4 variations, MC of the board will permit. This about next regarding credit delivery, it is only days only. I will not discuss in detail these days. Anyway, I am giving these notes. Only days are there. That means Kisan credit card within 15 days branches have to sanction. Loans up to 25,000 within 15 days they have to sanction. These are all 9 time norms is given. So these time norms. Because one question they are asking in time norms, table is given. Just you can go through this days. Within how many days you can sanction? RO, CO, HO powers ka kitne din? Time norms, these are all. Next, general matters I will discuss. What are all these general? First one is commitment charges. What is this commitment charge? Suppose we are sanctioning loans. Earlier I told you, this LSDBC may 200 crores we have sanctioned loan. Party has availed only 50 crores. Remaining 150 crores not availed. So we are losing some amount in that because you are keeping capital on that. It is lost to the bank if they are not availing. Then we will charge commitment charges. So here commitment charges are applicable for corporate borrowers with sanctioned limits, fund-based, non-fund-based or combination of both, 10 crores and above. Corporate borrowers enjoying 10 crores and above limits, for them these commitment charges are applicable. When these charges will be levied on unutilized or unavailed sanctioned limits only, either it is working capital or short-term or term loans, whatever it is. On unavailed portion only we charge commitment charges. Suppose if average utilization during the quarter is more than 75%, that means 100 crores we have sanctioned working capital limits, CC limits, party has availed 75 crores average during this quarter, then no charges. 75% at least party avail kiya to no charges. 50 to 75% avail kiya to 0.5% on unavailed portion only. 50 to 75% avail kiya to 0.5% on unavailed portion. Suppose 100 crores is loan, party has availed 50 crores or 60 crores availed. So 40 crores jo hai unavailed, on 40 crores par 0.5%. You have to collect. That will become the 2 lakhs. You have to collect. Next, if average utilization during the quarter is less than 50%, in such case, 1% on unutilized portion you have to collect commitment charges. This is commitment charges. Generally, maximum is 1%. 10 crores and above is applicable. If they avail at least 75%, no charges. 50 to 75% is 0.5%. And less than 50 is 1%. You have to utilize. And for generally, in case of term loans, the first disbursement as per sanction, it does not take place within 3 months from the date of scheduled drawdown date. Scheduled drawdown means they will give first schedule, first drawdown, first disbursement this date, second disbursement this date, like that they will give dates. If they don't utilize within 3 months from the date, then you have to charge. This is regarding term loans, right? And on that installment only, not on full amount again. Term loans may first disbursement say 25% he has to avail on this date. From that date, 3 months ke andar utilize karna. If they don't utilize for the 25% portion only, you have to collect charges. Next, penal charges. QoS and HOS. This is applicable for 5 crores and above. Party has to submit quarterly operating system or half yearly operating system. Quarterly operating system, it is to be submitted within quarter ke baad 6 weeks time it is given. हाफ ईयरली ऑपरेटिंग सिस्टम में हाफ ईयर के बाद 8 weeks टाइम इट इज गिवन, विद इन दैट टाइम दे हैव टू सबमिट, अदरवाइज you have to charge penal interest 1% on the fund based liability and 0.25% on the non fund based liability. If exclusively NMP facility is there, maximum cap is 1 lakh only. This is what penal interest in case of non submission of QoS or HOS. Quarterly it is to be charged. Next, where party is enjoying fund based and non fund based, in such case 1% for fund based and 0.25% for non fund based you have to charge. 1% delay for creation of EMT or second charge. Creation. Suppose we are in sanction itself, we say within 6 months or 1 year, party has to do mortgage, complete the mortgage. In that period, party has not completed, then 1% penalty for delay we will charge. Otherwise, parties may delay. That is why always if some charges are there, then only they will attend promptly. Next, annual financial statements. Yes, somebody in query also earlier asked. Annual financial statements means audited balance sheets. Party has to submit. When it is to be submitted? Within 7 months from the close of financial year, or within 7 months from close of financial year, or within a fortnight after adoption of accounts. So generally we call 31st October because our financial year is 31st March. So 7 months, 31st October is due date for submission of audited balance sheet. If party not submitting by 31st October, from 1st November onwards, we have to charge 2% penal interest for not submitting audited balance sheet. This is recalled question frequently. Next, enabling mechanism for meeting payment obligations. As per MSMED Act 2006, wherever banks are financing to large corporates with working capital limits of 10 crores and above, banks are to earmark sublimits towards repayment to small units. What MSMED Act says, small SME units may be supplying raw materials to larger corporates. Since larger corporates may do negligence to these fellows while repaying, ये तो छोटा आदमी है ना, हमारे ऊपर डिपेंडेंट है, पैसा बाद में दिया तो भी चलेगा, like that they may neglect. In such cases, small units may die because working capital उनका कुछ थोड़ा कम होता. When repayments are not forthcoming from large corporates, वो large corporate से पैसा नहीं मिला तो इसको working capital कम होता, so small units may die. To help small units, MSMED Act says, wherever banks are sanctioning working capital limits larger corporates 10 crores and above, you earmark a sublimit towards repayment to small units. This is what enabling mechanism. Prepayment penalty. Prepayment penalty. Yeah. Prepayment penalty 2% you have. What is prepayment penalty? You are sanctioning loan to a borrower, term loan, maybe 5 years repayment diya, and our asset liability match we make it for 5 years. Subsequently party आ गया 2 महीने में या 3 महीने में close करने के लिए आया. What happens there? Already while at the time you have sanctioned for 5 years repayment, to that extent funds our asset liability mismatched करके रखा. And 2 months में funds आ गया तो your ALM mismatch may happen, market risk आ गया हमें. To protect from market risk, we collect some penalty from this fellow. This is what prepayment penalty. Prepayment penalty we will charge for mismatch in our asset liability because of prepayment by this fellow without paying as per agreed terms. So 2% is prepayment penalty. If loan is taken over by other bank, then only this penal charge we will collect. If party says, sir, मेरे पास पैसा है, I am paying out of my own, then you cannot charge 2% penalty. खुद उसका पैसा repayment किया तो no prepayment penalty. Taken over by other bank है तो 2% penalty. But this prepayment penalty is exempted for all housing loans, number 1. Number 2, for all MSMEs also exempted, no prepayment penalty for MSME loans. And third one, for individuals loans diya other than business purpose, no prepayment penalty. So these are exemptions from prepayment penalty. Number 1, SMEs. Number 2, housing loans. Number 3, individual loans for other than business purpose. No prepayment penalty. Next, this is another important question. Validity period of sanctions for various facilities. Short-term corporate loan or corporate loan you have sanctioned, it is valid for 1 month. After 1 month, it is to be revalidated again. Working capital valid for 3 months. Term loans valid for 6 months. Ad hoc credit facility valid for 15 days. Within 15 days, they have to avail, otherwise it will be cancelled, because for ad hoc credit facility, there is no revalidation. And credit facility sanctioned under consortium lending. Here, maximum 6 months time is given. Here, one more condition is there. In consortium, 6 months time, why it is given? Consortium में क्या है ना? One lead bank is sanctioning, and lead bank is sanctioning loan means by keeping in view the financial closure, they give 6 months time. Financial closure nahi hua to another 6 months is permitted. So maximum up to 1 year only it can be revalidated. After 1 year, again fresh sanction is to be done in case of consortium. What is financial closure? Financial closure means tie up for full amount. Party requires 100 crores. Party के पास 25 crores margin is there. Remaining 75 crores, 2-3 banks से पैसा he is taking loan. So he has received a loan from 2-3 banks to the extent of 75 crores. Then we call it as financial closure. If 2 banks are sanctioned 25, third bank 25 crore sanction nahi mila, so financial closure is not happened within 6 months. So तीसरा बैंक के लिए time चाहिए, so another 6 months is extended. Then 1 year time mila consortium में. After 1 year, it will be again fresh sanction should be there. So this is about consortium ka. Next, validity period of sanction of working capital or term loan to NBFC is 3 months. This is very important for current year exam because this is latest change. It has come very recently. NBFC score, whether term loan or working capital, it is valid for 3 months only. Otherwise, term loans valid for 6 months. But here NBFC ka term loan ke liye 3 months only, right? Next, revalidation, same period it can be done except this one, ad hoc credit facility. Consortium or JLA 12 months already I told, up to 6 months. Okay. Duration of working capital 12 months already ito discuss kiya. Working capital is valid for 12 months. Earlier 18 months like that it was there. Next, review and extension of tenability. Another 5 minutes or 10 minutes maximum, I will finish up this policy. One policy will be over. And then risk management policy, it may take 45 minutes. I will cover in next session. So another maximum 10 minutes, please bear with me for lunch. Review and extension of limits. Other than high risk accounts, that means normal risk or moderate risk, maximum 6 months extension we can do. And 3 months at a time. That means limits are expired. 12 months permitted OD OCC. 12 months over. Balance sheet tayar nahi hua. Then we will go for extension. Maximum 6 months extension is permitted. At a time 3 months only permitted for low risk and normal risk. And moderate risk also. High risk accounts only once extension is permitted. That too maximum 2 months only. So low, normal and moderate 6 months, 3 months at a time. High risk only once at a time. Bus. Holding on operations. This is also similar to extension of tenability only, but this is applicable for in case of standard assets, stressed assets ke liye, holding on operations. Standard assets are NPA accounts not marked for recovery. Earlier we called non-LPD accounts. Now LPD concept is replaced with marked for recovery. So NPA accounts not marked for recovery. It holding on operations ke liye jana if they are not submitting balance sheet in time. Then there are no adverse features and irregularities are beyond the control of borrower. In such cases, holding on operations can be permitted. Here maximum period also 6 months, here also. At a time 3 months it can be permitted. Another 3 months will be extended. But holding on operations ke liye, the condition is that liability will be freezed. Liability freezing means liability should not go beyond the level accepted at the time of holding on operations. समझ लीजिए पार्टी का लिमिट 10 करोड़ है, होल्डिंग ऑपरेशंस परमिशन करने के समय 8 करोड़ इज लाइबिलिटी. So next 6 months you are extending time, up to 6 months 8 करोड़ से ज्यादा लाइबिलिटी नहीं होना. You may permit operations, but liability should not go beyond 8 crores at any point of time. Even we may prescribe cut-off amount also. What is this cut-off amount? Every credit may 1% or 2% we will adjust to our loan account. This is what cutback or cut-off. Okay. Next, rejection of credit proposals. Rejection of credit proposals from SC/ST beneficiaries by next higher authority. In case of HO power accounts, CAC or MC power accounts, MD, CEO or ED in his absence of MD or CEO. So this is regarding SC/ST beneficiaries. Government sponsored schemes can be rejected by branch, but rejection is to be recorded in branch sanction rejection register. It will be reviewed by next higher authority during branch visits. MSME rejection by concurrence of next higher authority. Educational loans also concurrence of next higher authority is required for rejection. Export credit proposals, rejection should be reported to MD and CEO through concerned wings. Any rejection, it should be registered in NV 139 web-based package, and it will be reviewed by controlling authorities during their visit to the branches. Next recent addition is Janasamarth portal. Any loan, it is proposal received through Janasamarth portal shall be rejected by next higher authority. Branches are not empowered to reject any proposal originated, and it will be next higher authority. Next, conversion of limits. Earlier, only one way was there, fund-based to non-fund-based. Now, both ways conversion is permitted. Fund-based to non-fund-based and non-fund-based to fund-based. But non-fund-based limits to fund-based, only letter of credit will be converted. Letter of credit and advance payment guarantee. It is for purchase of raw materials only. It will be converted into fund-based limits. LC limits can be converted as CC only for purchase of raw materials. Similarly, fund-based limits may be converted as non-fund-based. CC to bill financing or bank guarantees. It is also permitted for purchasing of stocks only. So, conversion of limit only for stocks purchase. Post-shipment to pre-shipment. Post-shipment, I told you, bill financing. To pre-shipment is CC account. Bill finance to CC not permitted. And CC to bill finance permitted. That means pre-shipment to post-shipment is permitted. PC to bills and not otherwise. Secured limits are not to convert as clean limits. One-way conversion from LC to BG for purchase of raw materials may be permitted for good companies, etc., etc. Exit policy, next one. Exit policy means we are asking the party to go out of the bank and take limits from some other fellows. We don't mind. But you leave the bank. This is what exit policy. Bejna, bahar bejna. Kisko bejte? Who are not having good dealings. What are not having good dealings? Persisting irregularities or defaults in payment of interest and or installments. Failure of restructuring or rehabilitation efforts more than twice in a period of 3 years. And borrower is rated as jail high risk. Consortium of MBA jail में high risk accounts. And internally rated CNR 9 to CNR 11. Willful defaults by borrower or group. Activity of the borrower is become uneconomical. Financial indiscipline is there. Steep downgradation in risk rating, more than 2 notches at a time, grading risk rating may. No go rated in our CBPR rating. All these are all triggering points for exit policy. Next, where we have to insist for personal guarantees of directors. In case of private limited companies, LLPs, registered partnerships, there compulsorily you have to take personal guarantee of concerned people. Next, in all loans 5 crores and above, Aadhaar number of applicant to co-applicant and guarantor, it shall be obtained and updated in CBS. Further, exposures exceeding 5 crores, CA certified net worth statement with UDIN number certifying the net worth of the guarantors shall be invariably obtained. CA certificate for guarantors, right? Next, unhedged currency. What is this hedging of foreign currency means? If our borrower has to pay some amount in foreign currency after some time, say he is importing machinery, he has to pay to the exporter of that country. That means he is importing here, he has to pay in foreign currency. Then we call as foreign currency exposure. Or he is importing some material from abroad, he has to pay to the abroad person, then it is exposure. Such exposures are there. That means if currency rate is high at that time, party may lose some amount. So he has to hedge whatever exposure, foreign currency exposure is there, it is to be hedged. In some cases, natural hedging will be there, we need not worry at that time. Natural hedging means party, he has exported something, he has to receive export proceeds in foreign currency. In such case, whatever foreign currency is receiving or his export receivables, that will be paid to the import material also. So natural hedging is there, we need not worry. Where natural hedging is there, party has to hedge this foreign currency exposure. For this, what we says, party has to submit statement to quarterly statement, what is his foreign currency exposure, up to what extent they have hedged. If they are not supporting the if they are not submitting that return, 1% penalty we have to charge. And yearly audited statement party has to submit. Audited statement, what is unhedged foreign currency exposure. And for this, again, for calculation purpose, suppose party says he has not submitted, party has not submitted unhedged foreign currency. For small people, up to 50 crores limits, 10 basis points incremental provisioning we add for them up to 50 crores. This is enhanced. Earlier 10 crores was there. It is enhanced to 50 crores. 10 basis points. That means 0.1%. It will be enhanced provisioning. That means standard assets, if they are not submitting this UFHE exposure up to 50 crore their limit, in such cases standard asset को 0.25% or 0.4% के अलावा 0.1% we will add, 0.5% we keep provisioning for standard assets. So remaining all we need not worry, it is a little deep one. Legal audit of title deeds. Cut-off limit is 5 crores and above as a part of RBIA. Otherwise, once in 3 years, they have to do title deeds. So 3 aspects here. Legal audit of title deeds, 5 crores and above is cut-off point, and 3 years is periodicity. Next one. Next, ECAI ratings, external credit ratings, they are compulsory for above 25 crores from banking system. So anybody is enjoying more than 25 crores, then they have to submit this ECAI ratings. External credit assessment institutions and domestic credit rating agencies are there. CARE, CRISIL, Fitch, ICRA, Acute, Infomerits. With anyone, they have to take reports. International agencies, Fitch, Moody's, Standard and Poor. 1 to 2 may they have asked one question. You identify which is not a domestic rating agency. So 3 domestic agencies plus 1 international rating agency given. We have to identify which is not a domestic rating agency. This is recalled question. So you have to remember what are all international agencies, what is domestic and what is international, right? External credit rating, okay. Monitoring of cross default, I will discuss in other one also it will come. It is repeated. I will discuss. Consortium meetings also, I will discuss next one. Third party entities, off balance sheet, only small one only, right sir. These 2-3 aspects I will discuss in the next, because already 145 ho gaya. 2-3 aspects only in this policy are there. These I will discuss in next class. Okay. Now we break for lunch 145, half an hour. I think 2:15. Please again join for this class. Thank you, sir. Thank you.
Thank you, sir.
Thank you.
Sir, one person is asking about.
Yeah, I will clarify. Yes, sir. Please.
Export credit who will reject it? Export credit proposal.
Sir, export credit rejection, they says branch can reject export credit. Whether branch is rejecting, ROCO are rejecting. but it has to be reported to MD and CO. They have clearly mentioned only this point. Any export credit rejection should be reported to MD and CEO through concerned wing. So it may be rejected at branch level or RO level or CO level, but it has to be reported to MD and CEO. For all others, they have told branch can reject, but export credit may simply, they have not mentioned in our policy itself. Rejection of export credits has to be reported. This is what they have mentioned, sir. So we have implied that it is branch or RO or CO, whatever it is. Yeah. Next, any doubts or yes, I will clarify before this. इसमें I will see what are all pending here है ना. Group risk आ गया. Recent changes policy which repeat charges for ASM. Charges for ASM they asked. I will cover in monitoring also. Up to 500 crores, it is 5 lakh rupees, and beyond 500 crores, 8 lakhs per annum plus service tax GST. That I will cover in next session also, sir. LDBC loan system for delivery of bank credits. It applies for 150 crores and above working capital limits from entire banking system, 150 crores and above. Minimum 60% should be working capital demand loan, and remaining can be CC. And next one, 20% on unavailed limits, capital is to be maintained. The 3 points in LDBC. Yes, escrow, somebody asked again. Escrow may 4 parties will be there. It is escrow account is opened for a particular purpose. 4 parties will be there here. One is banker. Second one is our customer. Second person. Third person is customer's customer. For example, I told you, banker is ourselves, and our customer is one power producer company, electricity generating power producer company, and his customer is DISCOMs, that is State Electricity Board. State Electricity Board, his customer. And fourth person is escrow agent. This is another banker where escrow account is kept here. So all funds received from consumers, electricity consumers, will be given to Electricity Board, that will be deposited with escrow account. And this amount will be utilized in waterfall mechanism. First, operation and maintenance, and second, towards taxes to government. Third, towards bankers' liabilities, interest and principal. And fourth is, it will be given to our customer, power producer. Like this, it is waterfall mechanism. So here 4 parties are involved, and one escrow agreement will be there. As per agreement, it will run. This is about escrow mechanism. Being urban lending, can we open escrow account as? Yes, in such case, only 3 parties, correct. Our banker may open escrow account, then 3 parties only, no issue. Only thing is, wherever this escrow account is there, proportionate sharing to other banks is very important. Proportionate sharing other banks ko karna. That means whatever recoveries are coming in escrow account, it should be shared among other lenders proportionately. If it is not shared, Reserve Bank will impose penalty. That is, being our bank, lending bank, can we open escrow? Yes, then 3 parties only, no issue. The RBI says 4 parties are there. It can be 3 parties also. If we are same person, lender and escrow may be same. We can pay escrow for fee maintaining. Yes. Yes, we can open. We will be paid. Yes, escrow fees is there for that also. Project appraisal and TEV are both are same. Project appraisal, technical evaluation. Technical evaluation will be done by technical people. And project appraisal, it will be done by same. Yes, both they can do same, or it may be different also. Normally, project appraisal will be done by project appraisal group or project appraisal cell. And TEV consultants are there. They are outsiders, TEV consultants. So 3 people, anybody can do project appraisal. Lease discount means our Canara rent is best example for lease discounting. Canara rent, we are giving loan to borrowers where they are supposed to receive some funds in the form of lease. They have given to their premises on lease to public sector enterprises or banks or some good offices, and from there they are expected to receive rents, maybe another 5 years or 10 years. So against this we will finance. But how much amount? Say 5 years at the rate of 2 lakhs. 5 years, 60 months in 2 lakhs means 1 crore 20 lakhs they are supposed to receive. But 1 crore 20 lakhs today, as it is, we will not take full value because 1 crore 20 lakhs is not received immediately. This year they may receive 12 into 24, 12 into 2 lakhs means 24 lakhs this year they have received. We take as it is 24 lakhs. Next year again 24 lakhs they will receive. Next year 24 lakhs we receive. Today we will take a discounted rate because next year 24 lakhs is equal to current year 22 lakhs or 20 lakhs only because we take inflation at a discounted rate. That means maybe we consider it 90% or 92% current. This is what discounted cash flows. Future receipts are considered today at a discounted rate, not exact rate. This is called as lease discounting, lease receivables discounting. NPV also similar concept. Tomorrow's 1 rupees, today's 99 paise. This is the concept here, right? Sanction of limits in case of MBFC. Yes, NBFCs, we can sanction limits, either working capital or term loans or different types of financings. Different companies, NBFC, different sectors we have seen, infra lending or asset financing, etc. That can be done. MD and CO, please clarify. Through concerned wing, yes, somebody has clarified. Project appraisal eligible. Project appraisal eligibility. Recent changes, project appraisal, project appraisal, 5 crores and above new parties, 10 crores and above existing parties, low risk and normal risk, and moderate risk, 5 crores and above for existing parties also. Project appraisal is to be done. For commercial real estate, irrespective of project, they have to go for project appraisal. CRE up to 5 crores, project appraisal is waived. These are project appraisal ka. Agriculture, 2 crores and 5 crores. 2 crores for new and 5 crores for existing. That is what. PDF already provided, and if any required, yes. Please don't mind this doubts or written policy that it is to be reported MDCO, but we will reject the mentions export credits. Yeah, export credits, whether branch reject or CO reject or HO, that RO rejection, it is not mentioned. Only rejections it is mentioned. That is why it may be at branch level or RO level or CO level. Export MSME next higher concurrence of next higher authority. Concurrence. That means branch has to send all details to next higher authority and ask for rejection. Then concurrent next higher authority will give permission. Whereas in case of SC/ST beneficiaries, application itself is to be forwarded to next higher authority for rejection. So next higher authority only will reject. That is the difference. Concurrent and rejection by. Modified turnover method. No, sir, our policy it is not given. Earlier, they have given modified turnover method, all for small units, 30%, 35% like that it is given. In case of technology also, they have given highest one. Lease discount receivables may highest like that they have given. But now in our policy, it is not mentioned. About last year and last before year, it was there. TRA waterfall mechanism applicable. TRA and Escrow, both waterfall mechanism is applicable. PPT 3-4 are there. I will share, sir. This is only for clarifications I have given. That now itself I will share with our Krishnan sir. It will be shared among all. It is only for class purpose I have prepared. PPTs I will share with Krishnan sir immediately. Yes, sir. So now almost time is 54 हो गया. Somebody is asking 2:30. 2:30 को आया तो again है ना next person sir time.
Ravi Kumar.
Yeah. Ravi Kumar, no issue. Ravi is he is such an energetic person, so no issue, sir. Ravi Kumar say he will continue because we myself or Jagannath sir so aged na, so some timings hoga tha. Ravi, right, sir. Anyway, that is up to Ravi. 2:20 or 2:25, whatever it is, let him see. Thank you very much, sir. We will myself I will call it today. Thank you.
Thank you.
Thank you, sir.
So friends, you can leave this session and join us at 2:30 sharp.